number, what do we have? Episode number 27 of Daily Market Mastery with me, Christian Rauchenwald. I'm sorry that I'm late today. Unfortunately, had some computer issues. Preventing me from using my webcam or my microphone and a few other things. So I had to, fix that real quick. And now here we are. Still need a moment to fire up everything that we need for the stream. So yeah, bear with me. As usual, if you have any questions, you can obviously ask them in the chat, and and then we're gonna jump right into it. It's Monday, however, the markets are closed today, so we still have a stream because we have our Monday review. So just gonna set up this, and there we go. That's set up. Chat is set up. This is set up. Just missing one more thing. I hope that works now. Stats portfolio. Okay. There we have also the portfolio. Yeah, and yeah, I think with that we're good to go now. I hope you all also had a nice weekend. As I shared last week, Irina and I spent the weekend in Amsterdam. It was an okay trip. I've never been to Amsterdam before, and now I've seen it. And to be fair, not sure if it's worth a visit. So I mean, now I've seen it, but I don't plan to go there again. If you've already been to Amsterdam, share your opinion, like how you liked it. Would you go there again? Would you recommend it? In the comments or the live chat below, depending on if you're watching this live or as a recording. That said, as usual, disclaimer applies. Everything that I share in this live stream / video, depending if you're watching it live or later as a recording, is my personal opinion and in no way financial or professional advice of any kind. You should always do your own research, consult certified professionals, draw your own conclusions, and make your own decisions. After all, what we do here in this live stream is I give you some insight into how I manage my personal portfolio as a so-called popular investor on eToro that you can check out by following the link that's pinned in the chat or in the description down below. And with that, I'm actually going to share my screen. There you can see my portfolio. As you can see, my overall return for the last 2 years is still above 50%, although this year so far we've taken a beating with minus 20%. Having a couple of months where if we look at the chart, basically in the beginning of the month, in the beginning of the month, very often we actually have a gain and then we suffer some losses. May was the same, good start, losses, recovering, and then suddenly having a few bad days that eat up the profit. And there we are with minus 20 for the year. I'm still confident that we will manage to counter that. However, it might be a little bit challenging. As you may have heard, there is a potential deal on the table for the US debt ceiling talk, which would obviously or debt ceiling, would obviously be good for the markets. However, it remains to be seen if that deal passes or not, which means if it passes, then that obviously might lead to a couple of positive days in the markets, which would mean, considering our exposure to the markets, or negative exposure to the markets for our relatively big positions in SPXU and SQQQ, would suffer further if that deal falls through, however, and the US would go closer to a potential default, then our positions would likely recover a lot, which makes it also a tricky decision if it's worth hedging or not. Personally, I'm against it, but we'll see how that goes. As for other positions, currently our Goldman Sachs position is still in profit. Our other positions suffered a little. We're gonna look through them right now. And basically we can go with that. By the way, in case you're wondering, switching cameras real quick. So which one do we pick? Let's pick, where's the button for that? Desk cam, that's the right one, and that one's also not working. Of course, nothing's working. Just a second. Studio mode, webcams, that's this one. Why is that not working today? Okay, desk cam's not working today. I don't think it's not even listed. Why is it not listed? Well, great, gotta love it. LG Hub Brio is listed, but why is that not listed? Okay, can I, okay, I will deal with that later. So no desk cam for this stream, really annoying. So so disable studio mode and go back here. No, not back here. Yeah, go back here for now. So yeah, desk cam is not working. I don't know what's wrong today. It's like one of the reasons why I really am glad that I switched from Windows to macOS, but certain things like the streaming setup still run on Windows. And I never have issues like that with my Mac. It just runs and everything runs smoothly. And over the years, there might have been once or twice that something behaves weirdly or so. Well, with Windows, it's just such a regular occurrence that it's super frustrating. Anyway, in case you're wondering, we're using the Elliott Wave principle or Elliott Wave theory to forecast or try to forecast movements in the markets or individual stocks. You can find a link to read the book online for free in the video description down below, and also to the one-page cheat sheet that I'm usually using. And yeah, that should help you. If you are new to Elliott Wave Theory, I recommend reading the book or checking out episode number 1 of Daily Market Mastery, where I go a little bit into the basics of how it works. Besides that, obviously, there are other books worth reading. I just finished reading Naked, Short, and Greedy by Dr. Suzanne Trimbath, who explains a little bit how, in quotes, crooked the markets, especially in the US, are because of fails to deliver. So most people are focusing on naked shorting, but there are like more parts to it. So loaning, naked shorting, and at the end of the day, all comes down to failing to deliver. And yeah, it's really an interesting read. I think a must read if you're investing in stocks, but yeah, you can check it out. And my next book is already here, and the next book is going to be The Interpretation of Financial Statements by Benjamin Graham. It's like a small book. I'm not sure yet if I like it or not. We'll let you guys know. But yeah, Naked, Short, and Greedy, definitely worth taking a look. Now with that, let's jump to the screen sharing. At least that is working. Yeah. So, and here we have the portfolio, and now let's take a look at how we're doing. So yeah, there we still have to log in as well. That's, by the way, Motive Wave is the software that I'm using to apply Elliott Wave Theory, because it has the, in my opinion, best Elliott Wave Theory labeling tools. Now, starting off with the SPX, nothing changed very much. Initially, I think when we started the stream, we were still here, and the conclusion was, okay, that may be Wave 2, and we might go down already. It turned out that was not the case. We're still well within the area where we are comfortable. However, like if there is a debt ceiling resolution, so if there is an agreement, then likely we'll see some more green days in the SPX moving up here, which means our SPXU position would suffer a loss. However, up until the 4,325 mark, I'm not really worried. It just sucks to see a temporary year-to-day loss of 20%, because obviously it dilutes the confidence that the people that copy my portfolios have into my management skills. But yeah, at the end of the day, none of my positions, or very few of my positions, are short-term investments, and most of them are long-term investments, which means in between they will move against me. No matter what I do, it will. I mean, that's the whole part of Elliott Wave Theory: 1, 2, 3, 4, 5, A, B, C. So there will always be moves against my positions. And the big thing is, if in the long term I'm right with my labeling, then in the long term it will outperform the markets, and short term there might always be some loss. Yeah. So anyway, so there's not much change here. We've already been at that level a couple days before. So yeah, like it just sucks, because we were looking at actually decent month with +1 or +2%, and the last couple of days just wiped all of that out there. And with the debt ceiling resolution, unless there is some, so that's definitely positive news. So I expect tomorrow to suffer a few more losses here, and once the market opens, and yeah, we'll see how it goes. Again, for now I'm still fine and confident with that. And in the NDX it looks the same. Just that the NDX already recovered more compared to the SPX. So if we zoom out here a little bit, we see, we're a little bit above the wave 4 range. We're still in the 61.8% or above it right now. Yeah, 61.8. So we already went above it. So here, yeah, well, very often we would expect to turn around at 38.2 or 61.8. Sometimes we might go further. Here it becomes tricky, but overall my outlook is still the same, that we will see a third wave. So it's like, yeah, I mean, the question is at which point I will start to hedge that position to just prevent further losses. But yeah, that's tricky. We'll have to look at this. Maybe I'll sacrifice an episode this week to try to analyze this better, or reanalyze this in order to determine better, like if we should just wait it out or if we should take some hedging action. Anyway, moving on. Shopify. Do we still have a Shopify position? Also need my spreadsheet here. Shopify, we closed in a profit already. So here we are basically for Shopify, moving here. For Shopify, we are now waiting basically for a potential drop down here and for a potential re-entry. So re-entry between 35 and 45. So again, like here we had actually nice profitable trades. And waiting here, then Black Knight Inc. Our position there is currently at a 7.5% loss. Here we actually have the situation that I mentioned in the last episodes that we might hit our stop loss here, but so far we are still fine. So it's just either I'm right with that 0, 1, 2 labeling, which means we will go up here over time, which gives us an incredible profit ratio because our risk is limited at 52 here, whereas our profit potential is above 100. So we have like a limited like 20% overall risk on the position, with potential reward of more than 100%. So definitely going to wait that out. Now, Ford, do we still have Ford? Ford is still open. Yes, in Ford, we are basically waiting exactly for this to happen, for a breakout here. So we label, I mean, it's not a big enough breakout here, but basically what we're waiting for is to say, okay, that if that corrective pattern is labeled properly here as a combination of corrective patterns, W, X, Y, with a triangle here, then we would see the breakout to the top following here. We'll just have to wait and see how it turns out. So that actually needs to be moved a little bit. Yeah, so that channel, that base channel is correct again. And yeah, we'll see how that turns out. And overall, in the long-term look, you can see that big 2 here. So the long-term labeling would be 1, 2, and now we would be in wave 3. And within that wave 3, that would be wave 1 and now wave 2, which means we would be in the third wave of a third wave, which means we would expect very strong movement, although not within a day or a week or so, because as you can see here, that here is the graph of multiple years. So we would basically say over the next 2 years, we would expect like a stronger ascent here. We'll see how it turns out, but yeah, like patience is the key here. Moving on, GameStop, still have the GameStop positions. There's a separate episode about GameStop, so I'm not going to go into that. And the episode would be episode number 9, in case you're curious. So you can just look for Daily Market Mastery, episode number 9 on YouTube to find that one. And yeah, so GameStop positions. I know they appeared a huge loss here, but I actually made incredible profits with GameStop during their not short squeeze in 21. So when the buy button got turned off, and we're basically still highly profitable on that position overall if we consider all the GameStop investments that I did on that basis. So yeah, we'll just have to wait and see what happens. Right now, we would have, if that is indeed 1, 2, 3, 4, we would be in the potential wave 5 where we should go up. We will see how it turns out. I mean, GameStop is one of the cases where naked shorting greedy from Dr. Susan Trimbath definitely comes into play. But yeah, so as I said, there's separate video about that also mentions why Elliott Wave Theory might not be that accurate in GameStop anymore as it used to be during this phase here. Yeah, moving on, Domo, we still have our position. Or we don't. Domo, we still have our position. It's at -10 by now. Yeah, we suffered a drop here. We would actually expect that wave 2 might have ended here. Turns out that it looks more like it's not the case, which means we would be forced to adjust this here, which means that here would not be like this, but that here would need to be like this, which means we might actually hit our stop loss here. Yeah, so because this is not how a zigzag pattern should look like, and that strong gap would indicate a third wave movement, which means that might actually be, can it be 1, 2, 3, 4, 5? Could also be 1, 2, and our wave 3, which means in Domo we might see a bigger drop or a further drop, which would hit our stop loss. Overall, we have a similar labeling here, so long-term 1, 2, and now wave 3, and we try to label this here as 1, 2, assuming that we're here now in wave 3, because obviously that part here would work out as an ABC corrective pattern, but that might turn out to be wrong, so we may not have that here yet. It's also possible that wave 2 hasn't finished yet, which would be a bummer, but again, like that's why, yeah, I'm not always right, nobody's always right, and here we're basically again betting that our risk-reward ratio is just too good to miss out on, because we don't have to, I don't even have to be right 50% of the cases to be profitable in the long run because of our trades that we pick with like very, very nice risk-reward ratios. But yeah, like, which means sometimes we will be wrong, and sometimes there will be times where we are wrong a little bit more often than we are right, and then there will be times where we are right more often than we are wrong. Yeah. Either way, so we'll have to wait that out and see what happens. Now we have SQ, so Block Inc. There we still have our, no, we don't have our position anymore. What was SQ? Oh, in SQ we're waiting for a drop to 30 to 35. while analysts predict an average an increase to 170 or so, we're saying here, okay, there's the long-term outlook would be that we go down to like 30, 35, whereas the short-term outlook could also be that there is this ABC corrective pattern, so which would mean that it might not play out by that time here, by July, but it might play out over time to get us back to around 170 before we go to 30. Either way, we're waiting to see if we see the drop. We would definitely enter in the range of 30 to 35. And if we don't see that range happening, then we would enter once we are clear that this actually is a breakout from that so-called base channel that gets us or confirms that we're now in the third wave territory, which obviously means, we would miss some profits along the way, actually quite substantial amount of profit, but then there would be more upside. And again, it's a long time thing, so we'll have to wait relatively long to either see that wave 2 goal here or to see that we're wrong and enter the upwards trend a little bit late. Yeah. Netflix, we are expecting, or I'm expecting, a drop to below $10, so nothing changed here. We'll just have to see how that plays out. So far we are saying, okay, if this is wave A, then that might be wave B, and then we might get to see wave C. But overall, we are expecting, or Netflix, the drop to below $10. Yeah, so yeah, we're expecting a huge drop here based on the overall long-term wave pattern that we may not see here because we might lack the history. Yeah, so our history is not accurate here. But basically, we would expect to get back into that range here, which is not the $10 range, but are we here at the $10 range? Yeah, it's $10 range. Yeah, so that's what we basically would expect. However, again, considering how long this took, we would expect like over the next couple of years to get down there. We'll see how it turns out. Either we are proven wrong and we see another high here, in which case we have to evaluate and maybe enter a position, or we just have to wait it out and eventually we'll have an entry. Then moving on, next one, Disney. There we are expecting, do we still have a Disney position? So we don't have a Netflix position now, but we have a Disney position now. And in Disney, we're actually thinking, okay, we are on the track to a new all-time high, which our expectation that here we are finished wave 4. To be fair, we could have waited here because we don't have if we're using Kennedy channeling technique. I'm honestly not sure why we didn't consider that, because using Kennedy channeling technique, we would have our deceleration channel like this, and we're basically waiting for a breakout from the channel to confirm that we're definitely in the fifth wave. Until then, the reason why we went in it anyway is because this here would be 1, 2, 3, 4, 5, and the corrective wave here often declines into the area of wave 4 of the previous impulse of a lower degree, which means we would wait till, or that's why we have our entry here, because the low is around 79, so $80. So it seems like a good entry point. Our risk reward ratio is again great because we can close the position at 84 if we're wrong, whereas if we are right, we will see like a huge upside here. So yeah. However, I have to admit that this one was an early entry. I should have also put the deceleration channel there and then patiently waited till we have a breakout from here before entering. Which means we would have missed some potential profit, but then we would have been a little bit more certain that we're now in the fifth wave actually. So we'll have to see how that plays out. Moving on, NEO, we still have a position, and NEO we just reviewed in episode number 21, and we expect it to reach $50. And there, if we go here, NEO, basically, NEO nodes expect, is that NEO? Yeah, okay. We are expecting it that it cannot drop below the 565 because that would invalidate this impulse wave and would turn it into a leading diagonal, which is a little bit problematic. And so we're assuming that, okay, we have a price target of, I'm not sure where we say 50 here, blah, blah, blah. There we have the retracement. It's so hard to recall everything that we did in half-hour-long episodes for each individual stock. But we have basically, why do we have that line here? That line here is about support and resistance levels, okay? And then where's our stop loss in NEO? Our stop loss is at 565. So basically we're saying, okay, that's how far we can go at most if this is 1, 2, 3, 4. Because other than that, it would then not be an impulse anymore, which means and we would at least recover around 70% of wave 4. So again, great risk-reward ratio. Yeah, same thing here. However, if we were to draw the deceleration channel, honestly not sure why I didn't do that here and in the other stock as well, because here that deceleration channel would look around like this. So we actually would still need to wait for a breakout till here to have a definitely, using Kennedy channeling technique, to have a definite confirmed breakout of wave 4. So we have wave 5 territory. Oh, sorry. Oh. So yeah, but it is what it is. Yeah, like I don't see a reason to change anything now. So we basically have a couple of reasons why we would assume that we will not drop further than here, which gives us some risk. But overall, the potential reward is just much higher. So yeah, again, we don't have to be right 50% of the cases. We only have to be right a fraction of the cases. Now, next one we have MU. That was, what was MU? Something. Do I see the chart settings? Show. No, inside, shade none. Nope. Scaling, team, axis, in display, labels. Okay, yeah, whatever MU was, it's hard to recall all of them. We don't have a position there at the moment. So MU was Micron Technology, yeah. Potential drop to 30 and then fifth wave. Yeah, so we're basically waiting for this potentially to happen and play out. So we're on track for that right now. So wave B and then wave C, and then we would enter at that point. Overall, we're also expecting that this is 1, 2. There is data missing in our charts here. 3, and that would be wave 4. And from wave 4, we would then have a fifth wave. So we'll see how that plays out. Yeah, for that, we also would need to have 1, 2. Yeah, that might actually be wrong. So we'll have to, we might need to reevaluate. So reevaluate. Wave 3 doesn't decompose. Yeah, so because the third wave always would need to divide in an impulse wave, and if we label that 1, 2, it might actually work out. So let's check the horizontal line here and put it here on the top, and it, yeah, like, so it barely checks out. So that 1, 2, 3, 4, and then wave 5, it barely checks out. So because that one doesn't retrace far enough. Yeah, so here we don't go below 916. So it actually checks out. So we don't need to relabel that. Yeah. So yeah, so there we are waiting. Then we have JP Morgan, where we also don't have a position open right now because we are expecting a correction, as we can see here, ABC, so down to 100 again, or in that area slightly below 100. We'll see how that plays out. So right now we would be waiting for BC to go down here, which then marks this point B, and then we finish that wave, and then we should see the finishing of that wave if we are right, in which case we then would re-enter here. Now there's potential profit to be made on the way up, I get that. So we're talking about a 20% profit that might happen here if we are right. But if we are wrong, we would consider, or yeah, like if we are wrong, then we would suffer. So if B doesn't go up that way all the way and we go down early, then we actually would suffer a bigger loss. So the risk reward ratio from this to this isn't big enough to justify the trade. Whereas if we turn out right and it goes then down to here, we have a great risk reward ratio. And if we turn out wrong and it goes further, we have an entry point here to indicate that it's a fifth wave. And we can also then make some profit there. Moving on to MS, so Morgan Stanley, and here we also expect a correction, as we can see here. Yeah, the points are a little bit screwed here, but basically we expect the correction to at least 46, potentially even further. It depends how we label this. Yeah, there is some inconsistency with the data here. That's why there are some warnings there. Yeah. But basically that's how it checks out. So again, we have the wrong data source here for the beginning. We made it properly based on looking up the data on TradingView. But so we don't have a position here. We wait again for a corrective pattern to potentially finish, potentially even at the $27 mark, and then take it from there. And which brings us then to Goldman Sachs. Yeah, Goldman Sachs would then be the next one, and the last one actually that we looked at, where we are currently expecting that we are in the fifth wave and on the way up here. Now we could be proven wrong, but we already corrected here way more than what we would expect based on the previous impulse wave. And overall, we would have, like if we look here, That's for giving us our profit target. So if we, okay, that's not 38.2, but if we divide it up, so usually an impulse wave chapter ratio analysis in the book that I cannot share because the desk cam is currently not working, would indicate that wave 4, either the endpoint, the beginning, or any of the points in between would mark potentially a 38.2 or a 61.8 retracement of the entire 5 waves, which gives us this incredible profit target here. So again, here our stop loss is fairly reasonable, and our risk reward ratio is therefore again great, and we just have to wait it out. It's also possible, however, looking at this now today with in quotes fresh eyes, that this turns into ABC and that we have more correction here to come, in which case that would turn into a trade that we don't win. Yeah. Overall, yeah, like, so for the rest of the week, we obviously will then tomorrow and so on, switching back to the camera, we'll then pick new stocks to look at to hopefully find new opportunities. Yeah, with our positions so far, while not all of them are moving the way we want, I'm actually overall happy with them. Obviously some mistakes happen, but that cannot be avoided. Again, nobody's right 100% of the time, and the secret in quotes is to be right either more often than you're wrong if your trades always have the same risk reward ratio, or to have trades with risk reward ratios where your winning trades are just so much bigger than your losing trades that you don't even have to be right more than 50% of the time. And then it just comes down to patience to wait out for the patterns to play out. Yeah, obviously I could spend the time, and if we circle back, I could spend the time, instead of looking on a monthly chart, I could say, okay, let's look on an hourly chart and work our way down here. So because we see obviously that whatever wave labeling we have, we're going to switch back to the monthly chart then, just so I don't get confused in the next stream. Yeah, so it takes forever to load, but obviously we could look closer and try to label each of this on an hourly chart, or I mean, now it already switched back to 2 hours because we're zooming out, or even lower. But it just becomes harder and way more effort because we have to start with the biggest scale available and then work our way down. Yeah, it would mean we would find a little bit better entry points and we could ride smaller waves. So potentially we would have, I don't know, be able to see this as 1, 2 or 1, 2. Yeah, so like here, for example, that might be A, B, C, which means this part here might be 1, 2, 3, 4, and then an extended 5th wave. And so we would be able to find potentially more entries, but they would be for very, very small movements. Yeah, so in relation, so we would spend way more time to find way smaller trades that might then have a higher percentage of being successful, but the risk reward ratios wouldn't be as good, and then the profit per trade would be far lower than when we're right than what it is the way we're doing it. Yeah. So yeah, and but that's pretty much it. So switching back here to the monthly chart. So since here we had the monthly chart, yep, and zooming in a little bit, yep. So that's what we've been looking at, and yeah, then circling back here. Now, obviously it's a little frustrating when I look at the portfolio and I see, okay, I've been outperforming the markets for a couple of years straight, no matter if it was a bull market or a bear market. And then this year, obviously, the markets are moving completely against my long-term outlook. But that's just, I think it's the result of the incredible year that we had last year, because I'm betting against the market long-term, because I think that we will have like a huge correction. But I said Elliott Wave Theory means that while the markets move up in, for example, a wave 1, or in that case, the markets move down in a wave 1, since we are overall in a wave 2, that makes sense if you understand Elliott Wave Theory and how the degrees of certain levels work. So while we are moving down in wave 1, which happened during 2022, and got me 45% profit, we now are moving up in wave 2, which is then counter trend, in this case upwards, and are suffering the current 20% losses before we then move down in wave 3. Now, if wave 1 lasted 1 year, then wave 2 should, but doesn't have to be shorter than that. So it's potential, or it's possible that we still have like a month or 2 of like potential losses that we suffer while we are holding our positions, before we then turn around into wave 3, which then is again highly profitable for us because it should be the strongest wave movement. It's like, I don't want to be like talk doomsday stuff or so, but it's also impressive in quotes that like right now, when we're waiting for wave 2 to end and the markets to then drop further, we are exactly at the time where something like the debt ceiling would be an issue or could be an issue. So if, for example, not enough Republicans are convinced that the agreement that their Speaker McCarthy made is good for them and vote for it, so maybe they cannot get it through the House because McCarthy's speakership has already been quite unsteady in terms of like how many votes were needed to even confirm him as Speaker for the Republicans or Speaker of the House. So it's possible, which would be, it would be fitting in terms of wave pattern from what I expect. Not saying that it will happen, but we would see like a 1 or 2 green days based on, yay, there is a deal on the table, but if they cannot get that deal approved because enough Republicans think it's a bad deal for them, then suddenly there would be panic in the markets because what seemed then as a greatly resolved debt ceiling issue, so suddenly becomes a shit, we didn't resolve it and we are defaulting, and then President Biden would need to enforce the 14th Amendment, which says like basically government debt shall not be questioned in any way, and then the Republicans would challenge that in court and whatnot and so on, and which would lead to more uncertainty in the market, which would align very well with a third wave move in the global economy, because it would create some uncertainty. And if we combine that like other countries like Germany, for example, officially now entered the recession and so on, and other countries are for sure going to follow, at least in my opinion. So I think like, it's hard to say. We might still in June see the markets go up a little bit, but the first week of June is where the default would happen if there's no consensus or no agreement on the debt ceiling. So if it doesn't get through the House and the Senate, and it's going to be interesting to see. So I expect the first week of June it's going to be tough for my portfolio, but I don't see a reason to close the position just for those couple of days, to be honest, because short-term tax implications are way worse than just waiting out certain things. And then basically in the second week of June, potentially, if things go south with the debt ceiling, we would already see probably a huge plus in our portfolio. And if things don't go south, well, then, there are other crises around the world that could affect the world economy. And with that, the NDX and the SPX to get us into a decent profit. Obviously, it's mixed feelings to root for or to wait for something, in quotes, bad to happen. But at the end of the day, I'm managing a portfolio to gain a profit and not to solve the world hunger, world peace, or any other problems. So, that's pretty much it for today. So not much new, to be honest. We're still in the waiting position with a lot of things, and we'll try to find new stocks and potentially indices to invest in the near future to balance our portfolio a little bit better, and to also, while the markets drop down overall on average, have positions that have the potential to go up to increase our gain further, but at the same time also serve as a mini hedge, because if the positions tend to follow with the market and the markets go up further and our positions go up further, then it would mean that our losses from the SPXU and SQQQ exposure are not that high, because our other position balance it out a little. Obviously, they're not as big, so not fully balance out. And if the markets start falling, and our positions maybe also turn sour, all of them other than the SPXU and SQQQ positions, then we have stop losses in place to limit the loss on the anyway smaller positions that we have in those individual stocks, and ensure that we get the almost maximum profit and payout from the SPXU and SQQQ positions. Anyway, as said, so that's it for today. Thank you all for tuning in or for watching this as a recording. I hope you were able to take something away. Don't forget, if you haven't, grab yourself a copy of not only Elliott Wave Principle, but also of Naked Short and Greedy by Dr. Susan Trimbath. Definitely worth a read if you're investing in the US stock markets, or actually in other stock markets around the world as well, because many of them are based on how the US stock market works. So with that, I am signing off. Have a great day. See you tomorrow in another episode.